Okay, first concept is what can you invest in? You can invest in trust deeds, mortgages, notes, rental properties, condos, raw land, lease options, building bonds, commercial paper, like and unlike exchanges. And what that simply means is you can buy a house and sell it and buy LLC shares, which are unlike exchanges because there's no taxable consequence. You can joint venture with somebody, which simply means you're going to do one transaction with them. You can use promissory notes, do notes on mobile homes, secured or unsecured, private placements, which are to a large extent a portion of a business, LLC shares straight up. You can buy businesses, precious metal, and tax liens. And in your particular state, tax liens are Georgia. The tax liens can be quite attractive to investors if you're not familiar with it. It's something you should probably want to learn. Okay, second concept is prohibited transactions. With every great opportunity, you also have to be aware of consequences. So what we're going to do is we're going to go through the prohibited transactions before we get into the case studies. The IRS rules and regulations and what's prohibited. If you use retirement funds to purchase property, you cannot live in the property until you take it as a distribution. To put it simply, you cannot receive current benefits from your retirement account. And what does that mean? That means if you have a home at the beach, you can't use it for 14 days a year. It has to be held for investment purposes only. If you have the need for a personal residence, you can't do that either. So those are some of the things that are just the very straightforward. You can't deal with yourself or use the assets of your retirement plan until you retire and you take it as a distribution. Now, disallowed investments. The interesting thing about the Internal Revenue Service Code, it does not tell you what you may invest in. It tells you what you may not invest in. And this is the list of what you may not invest in. Works of art, and you certainly don't want to invest in any rugs or antiques. I'm particularly fascinated by the fact that they've eliminated my ability to invest in rugs, because it just seems to me that specifically was something that everybody would want to do. I'm being facetious here, as you probably know. Any metal or gem, stamps or coins, alcoholic beverages, that's another one. Any other tangible personal property specified by the Secretary of the Treasury. At this point, it's pretty nominal. And then you can invest in U.S. government minted gold or silver coins and bullion. So you can invest in that, and that's and gold IRAs are quite popular these days also. Prohibited transaction is defined as any improper use of the IRA or the plan by a plan participant or a disqualified person. And the disqualified person is an employer of a participating plan. So, for example, if you have a set plan and you're a disqualified person from making a transaction with your own set plan. If you have a partner that owns 10% or more of the company, they're disqualified. A fiduciary of the plan, like a trustee or an advisor, anybody with a really high salary in your business that could have an influence over it, that's a prohibited person. And any other employee that's organization or any members that are covered by the plan. The plan in this case being defined as the IRA. The following are disqualified persons, and this is very easy to understand. It's not that complex. If you just think about the multi-level marketing where they go upline and downline, that's what we're talking about. We're talking about the members of the family, spouse, ancestors, direct descendants, and any spouses of their direct descendants. That's your prohibited people, and any of the entities that they own or control of at least 50% or more of the total stock of the corporation, capital interest or profit in the estate, and beneficial interest in the trust or estate. I want to sum that up for you. Think about it like this. Your parents, your children, any entities that they own or control. That's what it really boils down to. Aunts, uncles, cousins, okay, are not included. it says at the bottom of this particular slide, it says any siblings or relative which may influence a decision related to a transaction may be considered a disqualified person. That's what I put in there because you can't just say that cousins, aunts, uncles, and are not going to be, or brothers or sisters are not going to be prohibited people, because it does in fact go deeper than that. But the specific disqualified people, as it says on the slide, are you and your spouse, lineal ascents and their spouses, lineal descents and their spouses, any fiduciary of the IRA, an employee of American IRA, as well as their spouses or ancestors, and an attorney or a CPA who actually does work directly for the IRA, not just for you specifically, anyone providing services to the IRA, as well as their employees and blood relatives. So those are some of the things that are disqualified persons. And it goes, there's many other variations to this, but that's the surface of it that you have to be aware of. After you get past that, then there's not a lot to be overly concerned about. Examples of a disqualified persons is you cannot engage in a transaction, direct or indirect, with any disqualified persons. I'm going to deal with that first line there and then make sure that we're clear on that. Many investors want to ask the question, well, what if I do blank? And the blank is this. I sell the house to my brother sells it back to my IRA. Is that a prohibited transaction? Because the brother is not, on the surface, a disqualified person. Well, the Internal Revenue Service says, yes, it is, and that's called the indirect rule. You can't do anything directly or indirectly that you can't do directly. So that's the indirect rule. Or sometimes the attorneys or CPAs will refer to it as a step transaction. So you can't do that. Selling, exchanging, or leasing property, we've already talked about that. Lending money or extending credit. You cannot lend money to your IRA, you cannot extend credit to your IRA, and you cannot put your IRA up for a loan. It's a prohibited transaction. And furnishing goods, services, or facilities. I'm going to get into that in the case study, so I will leave that particular line to a later date, but just read that: furnishings, goods, services, or facilities, and I think it'll become clear to you in a few more slides. And the two key points of the IRAs and real estate is no self-dealing and no personal use. And if you just ask yourself, am I self-dealing, or am I using this personally, or am I receiving any current benefits, then those are simple questions you can ask yourself to find out if it could be a prohibited transaction. What we're going to go into tonight is some case studies, and these are actual case studies by a client. I did the interview last Friday, a week from tomorrow, and the story is quite fascinating, and it's a story that is by a real person doing real business today. We're going to talk about land banking. We're going to talk about secured loans for a mobile home. We're going to talk about single-family sale to a wholesaler. And then we're going to talk about the practice makes perfect, the home run, the hat trick, hole-in-one, 100-yard run back, and the game-winning shot from half court. I didn't cover the poker scenarios, but you get the idea. And these are case studies from one of our clients' accounts. David G. has generously agreed to share his story and give us permission to share it with you. And at the bottom, this is what I hear a lot. It says, American IRA, it's, in quotes I put, it's great to have real folks to talk about their retirement accounts. And that's what we are. We're real folks, and we can talk about it and help you and get you in the right direction. And we're here for our clients. Okay, we're going to talk about due diligence. This is not a IRA specific segment. What I decided was that since this is a course on investing in real estate that happens to be cloaked in the IRA function, We're going to be talking about due diligence during the case study, so I decided to put together a conversation on due diligence and give you a definition of that so that you can, going forward, you can understand what the responsibility is that you have as a real estate investor. And it's no different than you would have as whether it's the IRA making the purchase or you making the purchase as an individual. And this is not an all-inclusive slide. It's just a slide that incorporates many of the things that you would need to consider in your due diligence check. The definition of due diligence: an investigation. This comes directly out of one of the encyclopedias. An investigation of or an audit of a potential investment. Due diligence serves to confirm all material facts in regards to a sale / or purchase. As far as the real estate business is concerned, due diligence includes, but is not limited to, title review. You've got your inspections, which includes termite, radon, flood zone. You've got appraisal. You've got environmental assessment. You've got land use controls, permits for alterations and additions, which many times is overlooked. Professional consultation. You've got realtors, attorneys, legal advice. You've got surveyors. You have insurance agents. You've got your CPA for tax advice. And something that is many times overlooked in older properties with zoning is if the duplex that you're buying based on its income that's 65 years old but in great shape, can you rebuild that if it burns down to the ground? Because if you can't, you're not buying a duplex with a great income. You're buying a limited asset that cannot be duplicated to continue the revenue stream. So you're probably going to be overpaying if you're paying something that is not going to be able to be duplicated in case if it burns down. In all cases, you have to seek advice from professionals in helping you determine the due diligence items for your investment. To make it clear, this is for educational purposes only. An American IRA does not perform due diligence. That is absolutely the client's responsibility.